Hey everyone, IonQ is one of the leaders in quantum computing. Investors suggest that this might disrupt artificial intelligence over the next few years. So this might be the next wave of innovation in computing over the next few years. So some investors are asking, should they buy it now, ahead of the coming wave? Well, let's consider IonQ. Let me look at its financials. Let me look at its valuation and its prospects to come up with an answer if now is a good time to buy IonQ stock.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so let's start with revenue. And on a trailing 12-month basis, IonQ generated 22 million in revenue, which is relatively small considering its $2 billion market capitalization. Most of its prospects, most of its valuation is due to what it could be 5 years from now or 10 years from now, and not what it's doing today. Has relatively few customers, and its use case is not yet fully developed, although a couple of months ago the company did reach a innovative milestone where it could be more commercially viable. Still, just now getting going, not yet generating the big amounts of revenue to justify an increasing revenue count. The market cap compared to revenue is a large difference. That being said, if you look at for 2024, IonQ is expected to increase revenue by 73.7% this year. And then if you go further to 2025, that rate of growth is expected to accelerate to 115.4% in 2025. This is what I like to call second derivative growth. Not only is IonQ growing revenue robustly, 74% is robust, but it's increasing the rate of growth from 73 to 115. Phenomenal growth rates expected from IonQ as it develops technology to make itself more commercially viable and more use cases develop. It could generate increasingly higher levels of revenue going forward. So the prospects are excellent for IonQ. That being said, the company is losing significant sums of money on the bottom line. Its operating profit margin was negative 715.7%. It's a very long way away from profitability. Profitability is not something that any investor should expect from IonQ at any time soon. Any time in the next 3 to 5 years would be unrealistic to expect profits from this company. This is an innovative investment. This is a high risk, high reward investment, which is not expected to pay off for several years. Still, the company is demonstrating progress on this front as it started to generate more and more revenue. Its operating profit margin, although it's still negative, it's improving, it's moving in the right direction. I want you to get the difference between cash flow from operations and operating profit margin by taking a look at this brief clip. Cash flow from operations is one of the most vital metrics I consider when making an investment decision. If any financial shenanigans are happening, looking at this metric can help uncover the fraud. Moreover, looking at profitability without considering cash flow from operations can lead to a misleading picture of a company's performance. For instance, look at the example I have created here. The company reported a net loss of $250. However, when you look at the cash flow from operations, it was a gain of $35. How can that be? Well, two expenses a company must report on the income statement are depreciation and stock-based compensation. Importantly, these are non-cash expenses. Money is not leaving the company for these expenses. In the case of depreciation, when a company buys a machine for $750, it pays all of that price up front. However, generally accepted accounting principles require that the company take the expense over a period the machine is expected to operate. So if the machine is expected to last for 10 years, the annual expense will be $75 per year for 10 years, even though the company paid the $750 cash at the time of the purchase. Also, when a company offers its employees a stock option, it's not parting with cash. However, it must record the cash value of the option as an expense on the income statement. So moving on to the working capital items, inventory management is the easiest way a company can increase cash flow. The simplest case is when a business has 100 inventory units, sells 30 units, and doesn't replace those units. The decision would reduce total inventory and increase cash flow. As you might already be thinking, this isn't sustainable. Eventually, the company will deplete all its inventory and go out of business. Accounts payable is the money that a company owes another company and has not paid yet. And accounts receivable is the opposite. A company can increase its cash flow by collecting payments faster and paying suppliers slower. If done with skill, companies at scale can take advantage of these timing differences to boost cash flow by a couple of percent annually. Costco is one example that employs this strategy masterfully. Overall, if you observe cash flow increasing unsustainably, you should expect a reversal of that trend. The other big risk to consider is if you see a company reporting substantial profits but negative or weak cash flow due to rising accounts receivable. So now that you get the difference, you can see IonQ cash flow from operations negative 26.63 million, roughly around how much revenue the company generated in a year is how much cash flow it's burning through a quarter. Now, its revenue growth over the next couple of years may only worsen this trend because it looks like it's going in the wrong direction here. The more revenue it's generating, the more cash it's burning through, as it's using some of that to invest in further growth in developing its technology. So not yet at a point where it's generating economies in scale in this metric. So given that it's burning through cash, I want you to look at average diluted shares outstanding. The number of shares outstanding is an important financial metric. If a company issues more stock because it is running out of money or it wants to invest in a new growth project, it has the potential to decrease your earnings per share. Look up here, when I have a net income of 1,000 and shares outstanding of 100, my earnings per share is 10. You take the net income divided by shares outstanding and you get 10. But now let's say you increase your shares outstanding to 200 and you have the same net income of 1,000. Now your earnings per share is just 5. The same is true in the opposite direction. If a company is losing money on the bottom line and it issues more shares, it spreads out the losses across more shares, thereby reducing the loss per share, which is a tricky way to reduce the loss per share. Look at this point here. A net loss of 1,000 with 100 shares outstanding creates a loss per share of 10. But if you take that same net loss of 1,000 and you spread it across more shares, 200 shares, you now have a net loss per share of just 5. So it's a tricky accounting trick to get your losses reduced on earnings per share. So you want to take a closer look to see where the improvement in the loss per share is coming from. And you could see the company is diluting shareholders from 192 million to 205 million, 13 million shares diluted over the couple of years here. That's not too bad for a company that's developing this kind of innovative technology. It's done a good job managing that shareholder dilution. And then looking at its cash on hand, it's got about 35.66 million in cash and equivalents, roughly 1/4's worth of cash on hand. So in the near term, it will likely need to raise capital to continue to fund its operations. And finally, I wanted to look at its valuation, and it's trading at a forward price to sales of 24.77, which is on the expensive side when you consider forward price to sales ratio. And given the limited revenue generation from IonQ in the last year, I was not surprised to see this valuation. Although it's down from those very high levels of close to 500 forward price to sales, it's still quite expensive and still in the early stages of development. So for me, As an investor, this is still too speculative for me, too early for me to invest or recommend buying, although it is an attractive opportunity, although it is extremely innovative and exciting. I would place this on my list of stocks to watch and just keep progress on its technology, on its development, and see it processing forward and see it getting more commercially viable before I can start considering an investment in this stock. Thank you for watching this video. I truly appreciate it. I know there's a lot you could be doing with your time and a lot of other videos you could be watching. So I truly appreciate that you chose to watch this one. If you want to see more videos just like this, hit the subscribe or the like button. They'll both help me make more videos just like this one. Thank you again.